Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So the strike price is pretty straightforward. We know what that is. The asset price, the time left to expiration. Now, a couple things that aren't straightforward is the interest rate differential. So what is the U.S. rate, that short-term rate, the risk-free rate, what is that offering? And what is the opposing rate? So that is one part of the options premium. The other part, and that's a real big part, is how volatile do we think this pair is going to be in the future? The volatility is huge. So if I looked at U.S. dollar against the Australian dollar in November last year, we were looking at an approximation of about 40%. So 40% means that, believe it or not, which is really almost unprecedented, that the market thought that the U.S. against Australian would move about 40%. Today, the end of July 2009, we're down to about 15%. Now, probably you're all thinking, what is the right sort of estimation, the right implied volatility? There isn't any. This is a future prediction of how volatile the market's going to be. So you can use it to, gain a little bit about emotion. Maybe you can sort of target certain premiums, if you will, but it's never fully correct. It's never really wrong. It's just a best guess of what could happen. So let's take a look at 113.13. Using that Canadian, say that value of $1 US. If I was to go into Toronto or I was just in Vancouver, a $1 US, if the value was a 113, I would receive about 113. We know that when we go to the airport exchanges, it's probably going to be a little bit less on either side, but just for argument's sake, let's use 1.1313. If I was to take the inverse of that, I would get 8.88393883. And I'll show you why that's important too. You want to know what the potential value of it being the dollar-based and also being the Canadian-based. So let's just talk about, let's say hypothetically, we're talking about hedging. That's why we're all here today. Hedging $250,000 U.S. This is a U.S. Contract, if you will. It's a bit so. And whenever I'm thinking about hedging anything, I convert it back to the U.S. and then I go from there. That's, to me, is the simplest way to do it. So if I look at hedging $250,000 of U.S., what I'm going to want to do is, the numerator is my portfolio size. The denominator is going to be, remember we looked at 1.1313. We multiply that out by 100 times 100, because we basically take this the 113.13, multiply that by 100, because remember each contract is the multiplier is 100 to come up with the size of that contract. So it's my portfolio size divided by the size of the contract. Now, the size of the ISE contracts are actually dynamic. They change a little bit each day, so you want to recognize that. So if I'm looking to hedge $250,000, I would be considering trading 22 contracts. Now, some of you might say, Steve, how about if I wanted to do, buy, let's say, an out-of-the-money option, and I wanted to do a delta hedge? Now, of course, you're getting them a little more complicated. You can buy many, many more. John has a question, why is it 100 by 100? Well, think about how it's calculated. When we take that exchange rate, we multiply that value by 100. Okay, so that's the first 100, John. The second 100 is that whenever, it doesn't matter if you're trading an IBM option, Google option, you always receive 100 times that value. So you need to think of it, that's what you're really controlling. So it is 100 times 100, and that way you come up with that value of 11,313. So I hope that answers your question. So I look at that portfolio size, divide by the ISE pair value, like I said, which is 113 times 100, or 22 put contracts to hedge if I'm worried about U.S. dollar weakness. Which strike prices would I select? So I remember there was in, at, and out of the money options. So it's always based on risk reward. If I was looking at in the money options, they would be higher strike prices, and they would cost more. So those are in the money puts. I'll just put I for in the money puts. Lower strike puts are going to be O for out of the money, and they're going to cost a bit less. And of course, somewhere in between is going to be the A, or the at the money. So you're looking at essentially in, out, or at the money. And is there a correct one? No. It's going to depend on your own tolerances for risk. So I took a screenshot a couple days ago, CDD trading 113.13, looked at 6-month options and 9-month options. I'm really just going to concentrate on these 6-month options today. I just want you to know that there are other alternatives. But let's just look at 6-month options, both calls and puts. Now remember, calls are going to hedge the dollar strength. Puts are going to hedge dollar weakness. So let's first talk about dollar weakness, because if we look back at our chart, we don't really know what's going to happen in the future. We all have our own view. What's happened recently? Dollar weakness, right? We've seen dollar weakness down from, let's say, what number is that? Around 128. 128, so we started here around 128 months ago. Got as low as 108-ish. So, but we're using today around 113. I know that the real value is a little bit less than that, but now, so we're concerned if we're looking at puts, what are we thinking? We're worried that the U.S. dollar is going to sell down relative to the Canadian. So here are the different choices, right? I can look and say an in-the-money option could be $10.50, $7.10. An at-the-money would be $4.30. Out of the money would be $2.40 and $1.40. And believe it or not, there are many other strike prices. Remember, I just picked one for every 5 points. We actually have them every 50 cents. So every 50 cents times 5, I would add 25 other ones in there too. CDD puts are going to hedge the dollar weakness, as I said. So I'm looking at the puts. I'm looking at 6-month puts. Of course, I could look at the 9, but I'm just going to concentrate on the 6-month puts today. And I could say, okay, 118 is going to cost me about 15 grand. Let's say almost 16 grand. This does not include commissions. The 113s are going to cost me 9 grand. The 108s are going to cost 5, roughly, and the 103s are going to cost 3. So at first glance, you may say, oh, wow, I'll just buy the 103s because they're the cheapest. Remember, when I started the presentation, that one of the benefits of buying the out of the money is that it's cheaper. One of the disadvantages is it doesn't hedge you until you get down to below 103. So I have no hedge until 103. So that's a long way down from 113 down to 103. But if I wanted a hedge that would start almost immediately, the 118 is going to cost me almost 16 grand. So let's go through the math. What if, and I made one scenario. There could be zillions of scenarios. Because of all the different strike prices and calls and puts, I wanted to just keep it sort of simple and say, well, what happens if the Canadian dollar is CDD, which means the U.S. dollar sells off, the Canadian actually rallies. So if CDD is dropping, that means the U.S. dollar is dropping. So what happens if the U.S. dollar drops about 11.61% from here? And is that possible? Well, anything's really possible, but if you go back to the implied volatilities, I think right around today I looked at, I think the volatility was somewhere in that range, 12 or I think it's actually a little bit higher, 13 or 14%. So the market is saying that, of course, that's possible. The dollar could actually sell down another 11 or 12% easily over 1 year's time.
Thank you for listening to our podcast.